Hey guys, today I want to talk about a trade that I actually did that did not work out very well. Actually, let me back up. There's two trades. One worked out terribly bad and the other worked out fine. And, you know, a lot of people post their trades and more often than not, they post their winning trades. You don't see that many losing trades get posted. I find a lot of value when someone will post a trade that did not go very well. And that's what I'm going to do today. So as you know, if you followed any of my material, I like to sell options. And the way I do that combined with risk management is I use credit spreads. Spreads are a little different than just outright selling puts or selling covered calls. There's a little bit of nuance that you have to learn. But if you sell credit spreads above the market and below the market simultaneously, that is called an iron condor. My income system that I manage is a campaign style iron condor system, which means I systematically continue to sell condors, and if as one falls off, I'll add more and just kind of perpetually keep it going. Basically, it works very well when the market sort of goes sideways or is choppy, just kind of mean reverting up and back. When it gets into trouble is when the trend goes too far in one direction, and I have very specific rules. And basically, this video is a representation of when you don't follow the rules, you can get in trouble, and that's what I'm going to show you. So, you know, an investment guru would probably never show a bad trade, but I'm human just like anybody else. Sometimes I break the rules and don't follow them 100%, and when I do, it doesn't work out. So this is an example. I mean, I've been trading this system a very long time, and it really does work very well for the risk that you have to take. But if you mess around and do what I did, you can get in trouble. So that's what I'm going to show you. So here's a chart of the RUT, the Russell 2000. That's one of the instruments that I trade, that and SPX. These options are cash settled, so there's no dividends, there's no risk of assignment, everything's settled. So what you're looking at here is a 1 year chart of the Russell 2000. Down here at the bottom is a graph of the implied volatility. You can see here we're trading about 1680, 1690 or so. This is a daily chart. The implied volatility is high. It's about 33%, which is pretty high for the Russell. And this is a good time to put on a condor. Now, you know, obviously from November all the way up to July, so not quite a year, but 8 or 9 months, we're in a pretty solid downtrend here. You know, we've kind of butted up against these moving averages a couple times, and so if you were inclined to be a technical chart follower, you know, you would probably think more probable that we would continue to go lower here rather than higher. But you know, I don't really pay attention to that. I'm just trying to generate income from the condor. So I put on a condor at this point, and what I did is I sold the 1900 calls, which is right here. And the way I do my my system is a 10-point spread. So I sold the 1900s, I bought the 1910s, and I also sold the 1400 put, which is right here. So the 1400 put and the 1390 put. So 10-point spread. So if we go over here and look at this screen, this is the analysis program that I use to monitor my trades. So you can see here I sold 10 of the 1900 calls and bought 10 of the 1910s. That's my credit spread, or my call credit spread. And then I also sold the 1400 puts and I bought the 1390 puts. Okay, so this is puts credit spread below the market, a call credit spread above the market. You put that together and you get what's called an iron condor. So here is my risk graph. So the straight line is the payoff at expiration, and the expiration date is August 26th, which right here shows you 43 days. So this is 43 days. We want the market to stay between these two strikes. This beige area is 1 standard deviation. The blue area is 2 standard deviations. And here is our expiration. The curve line we can adjust with a particular date. So this particular date we're looking at it is July the 14th. We've got 43 days that we need to manage this. So what happens with these trades is, as time premium passes, or as time passes, the time premium of the options moves up, and this is our profit. And our max profit at expiration, if all this stuff expires worthless, is about $1,500. So I sell the calls and the puts. I get $1.50 is my minimum. If the volatility is high enough, you can get a little more than that, $1.60, $1.70. But I did this 10 times, so I've got 10 spreads. So there's my credit of $1,500. So how much does it cost to put this on? Well, the point spread is 10 points. Okay, so that's $1,000 in risk times 10, so that's 10,000. But we actually brought in a credit of 1,500, so there's our margin requirement, which is 8,500. So basically, we're risking $8,500 to make $1,500, which is a really good return. And the probability is fairly high that we're going to stay within this region. Well, I mean, it's one standard deviation is 68% of outcome, so we've got 68% from here to here. So the typical probability of profit on this type of trade is in the 85 to 90% range. Okay, so what we're going to do is we're going to step through this trade and see kind of what happens. So before we look at the risk graph, let's just look at the market. So here's our chart. So let's just go forward about a week at a time. All right, so we're up to 1817, and you know our short strike is 1900. So this is already almost getting in trouble. Okay, so here we are at 1840, and we're a couple weeks in. Let's go forward another week. All right, so let's go back a couple days. So we're at August 4th. Let's look at Monday, August the 1st. All right, so here we are. You know, the market was down here in this area when we put the trade on. Our calls were 1900. Our puts were way down here at 1400. So this is kind of skewed. We're kind of thinking the market's going to go lower. So our deltas are getting longer or shorter and shorter. But here's, you know, typically we're seeing resistance at these moving averages, and we're kind of getting a pullback. So here we've gone through this. We're getting a little stretchy, and we're approaching our short strike. So one of my metrics that I use to monitor this is the delta of the short option. So let's think back to just kind of basic option 101. The delta of an at-the-money option, whether it be a put or call, always has magnitude of 50 or 0.5. And think about that intuitively. Basically, one way to interpret the delta is what's the probability that an option is going to be in the money. Well, if you subscribe to the random walk, and that's basically how option pricing models are derived, then wherever you are, it's a coin flip whether you go right or left, up or down. So think about that. If the market is at right here 1882, then going forward we've got a 50% chance of being up or a 50% chance of being down at any time in the future. So that means if we had an option right at 1882, then that option's delta would be 50. And that's the way options work. You always have to remember an option's delta is 50 if it's at the money. If it's more in the money, the option approaches 1. If it's more out of the money, the option approaches 0. Now, if there's lots of time left, then that change occurs away from 50 and toward 100 or 0 very gradually. As time approaches expiration, or as the time premium comes out and we get less and less and less time left, that's where your gamma comes in. And when you hear people talk about gamma risk, basically what happens is your delta gets unbelievably sensitive, especially if it's right at the money, because at expiration, that delta has to be either 1 or 0. If it's in the money, it's 1. If it's out of the money, it's 0. So that delta gets driven to 1 or 0 as time passes. But at expiration, it's always, or I'm sorry, at the money, as long as there's time to go, the at the money option has delta of 50. So basically my metric says if the short delta gets above about 32 or 33, that's when you really need to start thinking about adjusting these credit spreads. So let's go in and look at this right now. So we put this trade on, I believe we said July the 14th. Yeah, so here we go. This is a picture of our risk trade. We put it on July the 14th. Here's the 1900 area. And you can see here, it's basically showing us that if we move way over here, we're going to have, this is a loss, and this is steep, which means our delta would be very negative, meaning we want the market to go down. Now, what actually happened is we moved all the way up here to 1883, which is about right in here, in this area, in roughly about 2 weeks. So let's fast forward this. So now, here's what this looks like. I mean, we're all the way over here on this line. Okay, now you can see my graph changed here. Well, why did that happen? Well, okay, so here we are. We fast forwarded to July 27th. We're 13 days into the trade. Let's go forward until the next morning. So here's the morning of July 28th. The market has gone up to, we're at 1861. Well, remember, our short strike here is 1900, but our put strike is all the way down here at 1400. Okay, so these puts are becoming worth less and less and less. So if we look down here, we got about, well, let's just call it half of $1.50. So if we think about 75 cents on each side, it usually doesn't work out exactly split. But if we think about half of our $1.50 credit being 75 cents, well, this is now trading at about 70 minus 75. This is like 5 cents or 10 cents, this put side, because it's moved away from it. So it's become worth less and less. So what I actually did is I closed the puts, and I'm going to figure out, let's see. There we are. So during the hour of 2:30, let's go look here. I closed the puts for 7 cents. They still had 29 days left to expiration. So basically, of this Condor, let's look at it again. So part of the credit came from the calls, part of the credit came from the puts. The puts, all of it has already basically gone away. So I sold this for half of it, so 75 cents. So I could buy this back for 7 cents. I went ahead and took that opportunity and bought that side back. So now what I'm left with is just a call credit spread. 1,900 calls short and the long the 1910. This is a 10-point spread. Well, this thing is really hurting right now. I mean, it's worth, here you can see our loss is about $3,000. Well, our total credit was $1.50. Well, this thing now at this point is trading for, well, let's see, here's the mid, 35, 31.10. So that's $4.25. So if I wanted to close this out, I paid 7 cents for the puts. I could buy this side back for $4.25. All right, and I got $1.50 for the whole thing. So $4.25 plus the 7 cents I bought for the put, so call it $4.30. So I would have, that's a pretty good loss, because I brought in $1,500, but I'm having to pay $4,300 to buy it back. So there's your loss, about $2,800. Well, should I do that? Well, how much time is left? 29 days. Okay, so let's look at this. Let's go back over here and look at the chart. Well, what's the chance that this is going to be above 1,900 in 29 days? Well, hard-headed me, and this is where I'm reiterating, sometimes you've got to follow the rules, take your medicine, and get the heck out of Dodge. So I'm thinking, wow, this is kind of extended. We're going lower. All right. Well, let's see what happens. Here we are at 1888. Well, we've already looked at the 4th. Let's go forward a week. So here's the 8th. So now we're at 1950. Okay. 1950, August the 8th. Let's catch it up over here to August the 8th. All right, here's what it looks like. So now we've crossed the line, and our loss is even more. Our max loss is, right down here at 8,500. So if we held it and it expired and it was above 1910, that's our max loss, 8,500. So here's the question: what do we do? Well, the market from the low of 1640 has gone in about 2 months all the way up to 1950. Well, in my view, in my paradigm, I am a mean reversion type trader. I'm not a very good trend follower. I'm always looking for the market to reverse and pull back to some sort of mean or like moving average. Well, what should we do here? Well, here's the thing that's interesting about these spreads. As long as time is available, this spread will never trade for $10. Okay, because as long as there's some time left, it trades closer to 5 than it does 10. Because remember I said a while ago, the delta of the short call is 50. So it's always going to price in that probability that, hey, it could go back to being worth nothing instead of 10. And so we're going to kind of play it safe and be close to the middle. Now, it's probably going to trade at $6, $6.50, $7, somewhere around in there. But what happens is, as long as there's some time left, it's trading closer to the middle than it is down here at the bottom. Now, if it keeps moving and gets further and further away, then you're going to get closer to the bottom, because the probability is higher that it's going to be, above this level at expiration. But let's go forward. So we've got 18 days left. Let's go forward 1 week, and let's go to the 15th. So now look, we're at 2,000. All right. Our trade is 1,900 and 1910. So we need it to be below 1,900 for it to expire worthless and us not to take any kind of loss. If it's above 1910 at expiration, we lose the full amount. So right now we're at 2,000. So we're 90 points away, which is about 3 or 4% above the other side of our spread. So let's look at it over here. So here we are, August 15th. So now, there we go. You can see that it's we're almost at max loss. Now, should I take this loss? Well, what's the risk reward? I've already screwed up. Okay, I'm in this thing. My account is really suffering here. But the thing is, I can only lose from where I'm at here, 7,800 to 8,500. I've only got $700 more of risk, and if I have some miraculous pullback, which looking at this chart over here, it looks like that should happen. It could be likely to happen. All we need is some, big Fed news or big global event or whatever, and this is very, very overextended, and we could definitely move back under 1900 and totally bail ourselves out. But as we get closer to it expiring, as if we're above 1910, we lose it all. Okay, so this trade I put on to make $1,500, and right now we're down $7,800. Okay, so that's not good. It's not good at all. So let's keep going. So let's go forward another week. All right, so we got a little bit of a pullback. So now we're at 1920 on August 22nd. So let's go here and look at August 22nd. So now we've got 4 days. Our market, let's zoom in a little here so we can kind of see this. So our market peaked up here at about 2020. So now we've pulled back. Now we've kind of got resistance at this line. So now what do we do? Okay, does the market go lower and continue to pull back? Well, now we're in a much more precarious position because now we're down $5,000, but we stand to lose about, another 3. So we've gained from here to here. We've made back our 3,000. So if you're looking at your P&L, that actually looks pretty good. But I absolutely 100% know that I'm either going to be at expiration up here, which is making $1,500, or down here losing $8,500. Okay, so what did I do? How did I manage this? Well, I closed 3 of them of the 10 on the 23rd, which is the next day. Let's go forward 1 day. All right, the 23rd. This is 2:30 in the afternoon. Let's see what the market did. All right, you see it kind of stopped its decline, and it's sort of heading back up. So we got a gap here, so it's not looking good. It's not looking like we're going to be under 1900 in 3 days. So what did I do? I got out of 3 of them at $6 or so, $6.50, right here about in the middle. All right, so remember when I put this thing on, I was trying to make 1500, but now since I've got out of the 3, so now I've only got 7 left, but now I've locked in the loss because I've already taken part of it. So here's my remaining 7, and that's where we're at. So what happens next? Well, let's go forward another day. So on Wednesday the 24th, up again. So here we go. Since the market's going up, our P&L over here is going lower, and we're losing a little bit more. So what did I do? I sold another one at like 7, and then I think I ended up paying on the very last day of expiration, I ended up getting out at about $8 or so. So my average cost for all 10 was about $7.10 or $7.15. I got out of 3 of them a little better than that, but I had to pay $8.25 or $8.50 for a couple of them. Now, why did I do that? Because I was trying to save this last little amount, and I was trying to juggle the probabilities of whether I was going to be above 1910 at expiration or below 1900 at expiration. So let's look at what happened on the last day. So this was Friday, August 26th, and let's set this to 1600. Okay, so here we're zoomed in on the last day, August 26th. Market closes at 4, and look what happened. We closed exactly at basically 1900, 1899.83. Okay, now I've already told you I got out of this trade with an average cost of about $7.20. So what that means is I sold my credit spread, my puts below and my calls above, the Condor. I sold it for $1.50 times 10 is $1,500. I had to pay $7.20 to buy it back to close it out to get out of it. Okay, so I lost not quite $6,000 on this trade. I was trying to make $1,500, and I ended up losing $6,000. Now, what would have happened if I would have just rolled the dice and held it to expiration? Well, I would have either lost $8,500. This is not showing that because I've already closed. There's only 6 here, and I was getting rid of these kind of piecemeal throughout the day, trying to wait for exactly this to happen. But I couldn't wait that long. I didn't want to wait, so I ended up placing the orders. I got one field, and I got another field. I ended up, my average out price was like $7.20. If I would have waited, okay, so here's 11 o'clock on Friday, and the market's at 1923, and I've still got 3 left. Well, I ended up getting out of these at, around $8.25. But if I would have just held on until the very end, the market actually pulled all the way back. Okay? Now, there's a couple morals to this story. Number one, do not let the market get across your strikes. When the delta, if the market gets to your strike, the delta is 50. My metric is start looking to roll it when it's at 30 to 35. That means before it ever got to 1900, you know, I started it back over here when it was up about 1880, 1885, 1890, approaching my strike. That's when you roll it. Okay, that's when you roll it. And let me tell you why that is. If your credit spread has some time left, like I just explained, it's going to be close to $5. Okay, it might be $4, it might be $6, but it's not going to be $9 and it's not going to be $1. If it's close to being at the money, between a delta of about 30 and 50, it's never going to be more than $5. It's always going to be somewhere in that $4 to $5 range. Well, why is that? Well, because of probability. If it's on the good side, if my strike price is 1900, okay, let's look right in here. If my strike price is 1900 and my market is just below that, what's the probability that that's going to be in the money? What's the probability the market's going to be across that? Well, it's going to be less than 50 because it would be 50 if it was right at it. So that's representative of your delta. So when your delta is 30 to 50, that's when you can roll it. Okay, and so when we roll it, what we do is we go further out in time and then further up away. So if my problem spread here was a 1900, 1910, so I'm short the 1900, I'm long the 1910, what I want to do is I want to roll that up to like 1920, 1930, or 1940, 1950. Well, sometimes you have to pay a little bit to roll it, and that's basically taking a small loss, but sometimes you can do it for scratch or even for a credit. So what happens if we cross that short strike? What happens if now we're going to try to roll that 1900 to 1910, but now the market's at 1915? Well, now we're screwed, okay? And the reason why we can't do that is because now our probability is higher than 50%. If our delta ever gets above 50, we're like 55 to 60. Well, what's that spread going to trade for? It's going to trade for more than 5 points. More than 5 points. Because 5 is your midpoint of 0 and 10. So now if your delta is higher than that, now you're looking at, you know, somewhere between $5 and $7 of what it's going to be. Well, how are you going to get between 5 and 7 if you're rolling to something up and out of the money? You're not. Okay? So the moral of the story again is always roll them before they get in the money. Once they get in the money, you're stuck. You can't roll it up and out and expect to get anywhere near scratch or for sure not a credit. Now, another something to add here, which is a huge no-no, and this is really what I was trying to avoid once I got crossed up on this trade. What you don't want to do is you don't want to pay a debit to roll it and then the market continue against you, and then you be in the exact same situation, because then you're just increasing your possible loss. So in other words, if I would have rolled this and I would have paid $1 debit, I could have done that. And you know, if your spread ends up crossing and now it's worth $6 and you roll it down to, you know, and you sell something worth $4.50, well, that's $1.50 debit. Well, if you pay that $1.50 and now your $4.50 becomes problematic and you've got to roll it again or you've got to take the loss, then now you've just added on to your maximum risk of 10-point spread minus your credit, which in our case was 8,500. So you got to be careful. You can't pay a big huge debit and then have the spread where you can't continue to roll it, or then you're really messing up. So that was what I was kind of trying to avoid here, and that's another caveat that I wanted to add. A lot of times what I'll do is I'll pay a little bit to roll them. So if I get one that's in trouble and I want to roll it, I'll pay 20 or 30 cents. You know, if my original credit was $1.50, I'll pay 20 or 30 cents. Now what happens is, if you sold it for the whole thing for $1.50, you know, in our situation, we closed out our puts early, so now we're only dealing with the calls, but our credit was $1.50. Well, now let's say this thing is $3.50 or $4, well, now all we got to do is roll up and out and find another one that's $3.50 or $4 that's got more time and a little bit higher just to give us more room. Well, if we can do that for, you know, a 10 or 20 cent debit, or just call it scratch, well, now we've got that much in our credit spread that's all going to come out if the market stays below that short strike. So basically what you're doing is you're taking a loss because you were wrong. You sold the credit spread for a certain amount, and that credit spread is more expensive now, which means you lost because you're having to buy it back. But instead of actually taking and realizing the loss. You're just pushing that loss into more of a credit higher up and farther out, and you're hoping that the market is going to cooperate with you and stay under that new short strike, which will allow you to recoup that loss, but it'll also allow you to recoup the original credit. So as long as you keep pushing it out and pushing it out, you can kind of prolong your gains by just sort of saying, well, crap, I got to add another 2 weeks or another 3 weeks. But eventually the market's going to stop going up straight up in a straight line. It's going to pull back, and I'm going to do okay on this. That's usually what happens if you roll it when you're supposed to. Now, I didn't sit around with my finger up my nose and not try to roll this one. I mean, as it's got up there to, 1900, I was putting orders in. But what I was doing is I was putting limit orders, and I was saying, okay, I want to roll this from 1900 to 1910. I want to roll to 1920, 1930. I'm rolling out 2 weeks, and I'm going to do it for a debit of 35 cents. Well, the market never filled it. And that happens. It depends on the liquidity of the options. It depends on the market makers yinging you around. It depends on a lot of things. But sometimes you got to pay up and roll it. If you don't, and it gets crossed up, I mean, by the time I'm short this 1900, 1910, by the time the market's up here to 1950, I'm screwed because I can't roll that. I just can't do it. I can't roll it. So I ended up managing this trade, and I saved a little bit from the maximum loss. I got out at 720 instead of 10. But if I would have had the cojones to just leave it alone, I would have came out a whole lot better, and it would have been $5,000 difference if I would just left it alone because the market came all the way back down here. Now, how in the world do you predict that on the very, very last day, the market's going to drop 3.5% and bail you out? Well, you don't. That's why you don't let yourself get in that situation. So I was very frustrated with myself and how that trade, not because I didn't know what to do, but because I wasn't aggressive enough in rolling it. And that's really the message that I want to convey in this video is if you're going to roll, be aggressive and get the roll in, okay? I mean, I'm not advocating using market orders because they'll rip your face off, but put the order in. If it doesn't fill, move it up a nickel. If it doesn't fill for 3 or 4 minutes, move it up a nickel. Most of this stuff is algorithmic anyway. There's not somebody sitting there looking at it. But if it's a problem trade and you need to get it moved, then don't sit there and just hope that it fills. So because you get these big huge up days that move against you, and then you get another one. I mean, here's an example. Here we went from 1887 to one day 1920. The next day the high was 1957. I mean, look at that. I mean, that's just killing you if you've got this trade on, and I wasn't aggressive enough in rolling it. So now let me show you another one that worked out, that was kind of the same situation, but it worked out better. Okay, this is a trade that originated quite a bit before this, but what tends to happen is whenever one side will get challenged, I'll roll it for like 3 or 4 days or a week, and I'll push it up and give it a little room. But then sometimes I'll add a spread on the other side. Rather than just managing a credit spread, a call spread, or a put spread, I'll add the other side to it because there's no additional margin and it's just more premium. It actually reduces your risk to have on the Condor rather than one side, because if the market moves against you, at least you're collecting on one of them. So you kind of have to be careful. But this is one that I was kind of managing down. It only had 6 days to expiration, and this got real narrow. But you see here, I've got a really nice credit. And this risk reward looks a lot better because I can only lose 3,000, but I can make 2. So I'm managing it the same way. So let's look at what happened here. Okay, so here's this trade on Thursday, September 8th. I've got these September 14th, so they've got about 6 days. So between Thursday and Friday, you see how we moved up here. So we moved away from the puts. So at some point on Friday, I got rid of the put side, and so now I only have these 1880, 1870 calls. So I'm short the 1870, I'm long the 1880, 10 points of risk here. But the metrics and the risk reward is a little bit different on this one because I've already collected a whole bunch of premium. Because when I put this on, it wasn't an original $1.50 credit out of 10 points. It was closer to, I probably already received $3 or $4, maybe even $5 on total credit on this trade. So I'm just managing this one in the same way, trying to get out of this with the market being below 1870 when this thing expires, which is today, actually, September 14th. So here we're last Friday the 9th. So we've got about, well, Monday, Tuesday, Wednesday to go. So let's look at the market here. All right, so on Friday the 9th, we got kind of a run up toward our strike. Remember, our strike is 18, we're short the 1870, we're long the 1890. So we need a pullback here. All right, so let's go to Monday. Okay, so here we are on Monday the 12th. You can see the market closed up here about 1906. So we're like 20 or 30 points, about 2% above where we need the market to be. So I'm in the same boat. I'm either going to lose this full amount, or if we get a pullback, I'm going to make the full amount. So yesterday was Tuesday, and our Fed chairman came out and talked, and the market did not like what he had to say. So, or actually, I don't think it was the Fed chairman. I think it was one of the inflation reports, and the market was down about 3.5 or 4%. So I was sitting right in here. Market was at about 1900 or so. Well, yesterday it actually was down about 4%. So we dropped all the way from 1900 to about 1820 or 1830, which is like down in this area. You can see my little dot there. And then, so today all I had to do was make sure the market did not go back above 1870, and it closed at about 1840. So this trade I only had on 5 times, but it was still, the credit was, the total was $2,500. It was I had $5 in the spread. So basically it was a $5,000 swing, and it worked out this time. So this one was not quite as bad as the last one, just because the risk reward was better. Risking $2,500 and making $2,500 is different than risking $8,500 to make $1,500. That other trade, the Condor, I managed terribly. This one was had a little bit more sense to kind of wait and see what happened. But anyway, this one worked out very well. But the same principle applies. If I was going to roll this, you can't roll it if it's in the money. You have to roll it. You must roll it before your delta gets above 50. You really need to roll it before it gets more than about 42. I try to roll about 35. So anyway, I hope I didn't confuse you if you're not ready for this. But if you trade condors, this is a really good concept, and actually even just credit spreads. I mean, basically selling a put credit spread is just like selling cash secured puts, but you're buying insurance. So wherever you buy that put, if you buy it 10 points below or 25 points below, you're paying for insurance if the worst happens. But the way you look at the risk reward is different, because you've got a certain credit, but then you've got a certain spread, and the amount of distance between your two strikes is your spread amount, and then your credit that you brought in, you compare those two, and that gives you sort of the risk reward of the trade. So the moral of the story is, if you trade condors, I usually set them up with about 10, 11 delta with 35 to 45 days. The system works great for me. I've learned to manage it very profitably. But like I showed here, if the market gets going in one direction too long and your short strike starts to get challenged on either way, the call or the put, you got to be ready to roll it, and you can't mess around and get caught not rolling it, or you can end up in trouble. So hopefully that helped. If you've got questions, let me know. I've got courses, I've got mentoring programs, I've got a podcast, getting ready to launch a book. So a lot of stuff coming at you. Let me know if you have questions. Look forward to talking with you. Thanks.